Okay, I hope all of you can see my screen.
Yes, sir. Yeah.
All right, all right. So I'll not go through the introduction. As you know, we will be covering budgeting. My introduction was given quite elaborately by the organizing team. So let me just move to what we will cover today in terms of um, yeah. So the topics that we will cover today are the following. From a budgeting perspective, of course, the easier part is how do you do the budgeting and, um, the more common things of where all should our income go. And I'll share with you my perspective of, um, how to optimize uh, your allocation so that you can not just take care of your running the household, but also allocate your income in a certain manner or do the budgeting in a manner where you can also create long-term wealth for yourself. Um, and then I'll share with you how to create an emergency fund. Again, it's based on experience um, and some principles which work quite well, and then some principles to create wealth. Because a budget, if it is just meant to cater to our daily expenses, achieves only partial objectives. So how do you create wealth? I'll share some principles with you. Some of them are fairly well known, and some of them, I can share from my own experience. Okay. All right. And please feel free to ask questions. You can stop me while I am taking you through these. The pages I'm sharing with you are only to anchor the discussion. So please feel free to ask questions. Now, the objectives, as we all know, the major heads from a budget, from our income, where we need to spend our incomes are, of course, running the household expenses or running the household like groceries, school fees, insurance, rents, etc. The other two objectives are we want to all save for the future. So we want to save in various financial instruments like equities, debt, gold, property, etc. And then, of course, entertainment, because we're all living to live a good life and not just to struggle for meeting our day-to-day expenses and then saving everything else for the future. So we also want to live in the present day. So entertainment is, these are three broadheads. If you really think about it, everything falls under these. Your rents will fall in running the household, your every kind of investment in mutual funds, gold, property. If you want to buy property as investment, falls in the second category, and movies, dining out, pubs, everything else falls in the entertainment category. So these are the three heads which cover almost everything that you want to achieve from your income. All right. Any questions so far? All right. So what is the nature of these expenses, and what is my sense of, um, how you should, in your mind, decide the allocation for three heads. So, as we all know, household budget is running the household is more or less non-negotiable. You will need food, you will need to pay your rent, you will need to pay the fee of children. So those are mostly non-negotiable. The insurance premiums, etc. Um, from whatever is left from your income after non-negotiable, the principle which I recommend is set a minimum target for savings every month. And I'll give you an example with a small, with a 50,000 income household on the next page. So set a minimum target per month, and then entertainment as a balancing figure. Now, balancing figure doesn't mean that if you're earning $100,000 and your household expenses are 25,000 and savings is 25, then you kind of make it the balancing figure. What I mean here is your saving should be a good amount of your disposable income. So if your disposable income is out of, let me just go to the next page. If your income per month is 50,000, let's say that's your carry home salary, then let's say your household expense is 25K, then I will call 25 as discretionary or, at your disposal. My suggestion is go for 15,000, for savings, and the balance 10,000 for entertainment. So if your income is 100,000 and your household expense uh, obviously still remains 25K, or if you are slightly more lavish in spending because the income is 2x of 50K, let's say it's 30K or 35K, then I would still suggest allocate a big sum to savings and the balance to entertainment. All right. So savings is something which you should allocate uh, quite generously too, because that's where your future gets insured. Okay, and these are things which are not easily appreciated when you're very young, when you are uh, 24, 25, 30. But as you get into your 40s, you do realize it and do feel that you wish you had started much earlier. All right. Any questions so far?
No, sir, we can see none in the chat box.
Okay. Now, some principles for creating an emergency fund. Two categories here. Um, and largely the emergencies arise these days out of two things. Health emergency is the first category, and loss of income is the second category. Losing a job, especially in COVID times, lots of people lost their jobs, especially in hospitality, airlines, all the contact industries, all the hypermarkets which were shut down, the restaurants which were shut down. Lots of people lost their jobs. So here are two recommendations from me to meet the emergency fund or fund requirements. So for a health emergency, you must keep about 100,000 as aside in a liquid form like a fixed deposit. And I'll tell you why. I recommend liquid like fixed deposit, and always have a health policy. Never procrastinate having a health policy. Always have a health policy, which is almost 100% capable of covering any health emergency, right? And the private hospitals these days, they charge a lot of money, but thankfully, most of it is covered by health policy. So once you have taken a health policy, you are more or less covered with your 100K of liquid funds, which also you may or may not need. But 100K is a good amount to set aside in a fixed deposit. You can actually keep it as cash at home. You can also keep it as a cash in the savings bank. That's entirely an individual's choice. Given that we all have credit cards, we don't need this. The hospitals take credit cards as immediate deposit, but always have sufficient amount of money which is liquid, which is not tied up in either shares or mutual funds or property, because those are not easily liquidable or cannot be easily liquidated in case of emergency. Your shares may be running in loss, your property may not sell for 6 months, 9 months. So you've got to keep it liquid. Loss of income, finding a job is not guaranteed within a month or 2 months. So my recommendation is keep about 6 months equivalent of your non-negotiable household expense. So in our example, if your household expense is about 25,000 per month, then you should keep about 150,000 rupees in liquid form like FDs or gilt funds. Now, why do I say gilt funds? Because you can liquidate them in one day. If you liquidate them, if you ask for a redemption of a gilt fund, you get the money on the next day. All right. I see some questions now.
Yes, sir. Would you want us to read them out, or are you comfortable reading them yourself?
I can read them out. Or you can read them out because I'm sharing my screen.
Sure, sir. So there's a question that says, should we follow the 50-30-20 rule?
No, so like I said in the, if I go to the previous page, let me just do it for you right away. So let's say this is 100K. Okay. Okay, so let's not change it right now. Let me just talk through it. So let's say this is 100K. Your income on the top is 100K. Then I don't want that your household expense will not go to 50K just because your income has doubled, right? Your household income may go to 30K or 35K max because now you're probably spending on organic food versus the normal food. You may have taken a better house than the one you're living in previously. So let's say your income goes up to 100K, but your expense goes up to 35K or 40K, right? Let's take 40K in this example. So you're left with 60K. I don't want you to allocate, 15K to savings and the remaining to entertainment. What my recommendation is, out of 60K, you allocate about 40K to savings, all right, and 20K to entertainment. So you double your entertainment expenditure, live a good life because you're entitled to it, but you have more than doubled your savings. From 15K, you have gone to 40K. So you should never, at an early age, uh, you know, have a target of spending almost everything on entertainment, on drinking, on dining, on movies, etc. You should always think that in future, whatever you're saving now will come extremely handy because the power of compounding would have made that money or double that money or triple that money depending on the number of years, or made it 4 times, 5 times, and you will actually feel very good about it in your 40s and 50s.
Okay, so the next question we are having is, what are the easiest and the fastest money saving schemes like insurance, jet funds, gold, share markets? What else do you suggest?
So I'll cover that in the next page. Is there another question?
Yes, sir.
Yeah.
Where should we keep this money?
Okay, that's again in the next question. So are any other question?
Yes, sir. We are having more. What are gilt funds?
Okay, so let me just go to the gilt funds. Gilt funds are basically the mutual funds which invest in Government of India bonds. So they are the safest form of mutual fund investments. So there are two categories of mutual funds. In fact, there are more, but let me just stick to two. Mutual funds which park your money in shares or equities, and mutual funds which park your money in debt. So the debt can be, let's talk about the second category now, the debt funds. The debt funds can be again of various types. For example, a mutual fund can invest in the debt issued by, let me just take the example of a very famous company, Unilever Limited or Procter and Gamble, right? So let's say Unilever or Hindustan Lever in India issues some bonds which the mutual fund buys. The mutual fund that we're talking about buys. So that's a mutual fund which invests in the commercial paper issued by private companies. Similarly, there could be another mutual fund called a gilt fund, which actually invests in the debt issued by the government of India. And that's why they are called gilt funds, because they are 100% safe. Now, Unilever can, for a minute, we can say it can go bankrupt and you can lose your money. Although it's AAA, a company like that. But there is still some degree of risk if the money which has been parked by the mutual fund uh, belongs to a company or is in a company which goes bankrupt, like Dewan Housing went bankrupt last year, right? It was a company which committed a fraud. So mutual funds which had parked their money in the bond issued by Dewan Housing actually lost money. So the investors of that mutual fund also lost money. But gilt funds can never go wrong, because they are guaranteed by the government of India, and they can never go wrong. You will always get your money back with interest, always. Okay.
So, right. So there are two more questions in the chat box. Would you like to take them right now or maybe later?
The savings one, Those two?
No. So there's a question saying, can you give an example of health policy for young professionals?
So, the health policies are, in any case, designed in a manner that the premium is very low when you start young. So when you say a young professional, the health policies have features like, do they pay you a single room rent or a double room rent, or on a double occupancy? Do they cover what kind of, expenses are covered? Pre-hospitalization, which is in most cases, but the policies remain the same for various age groups, even for young professionals. The only difference is if you start young, right? If you start at 15 or 20, in fact, a father can take the policy or a mother can take the health policy for a child immediately at birth. Like I have taken the policy of my son when he was born. So what happens is the premium is very low for a young person. When you reach 40s and 50s, the premium becomes very large. And beyond 60, the health companies don't even issue policies, which is wrong, but they don't even issue health policies. So when you say what is a good policy for a health for a young professional, every policy is good. You've got to choose a policy on the basis of the features. It can be from Max Bupa, it can be from Tata AIG, it can be from Prudential, it can be from any company. Just compare the features and start early. Every policy will have a very, very low premium for a young professional. Okay.
Sure, sir. So I think that is another question that has been answered, and this is from Nikita. She asks, what are things that should be kept in mind while taking a policy?
So, the things which you should keep in mind while taking a policy is, some things again, which I've learned from experience. If you, if you are, what kind of room sharing will the policy reimburse? So if you want a single room, then take a policy with a single room coverage. Otherwise, you'll end up losing 50% of the coverage. If you're okay living with occupying a double occupancy room with the hospitals, then it's fine. To reduce the premium, the hospitals, even the policies also have a multi-occupancy kind of a cover, which means that, in a big dormitory kind of a room, there'll be 5, 6, 7, 10 patients. So you can take that policy as well. And the policy premium is less, but it entirely depends on you. So whether you as an individual likes a policy which covers, which entitles you to a single room or a double occupancy room or a multiple occupancy room. That's one. Two, I think what you should see is what kind of coverage is there in the policy. If there are too many exclusions in the policy, then you should not go for it. Like, they say we will not cover pre-hospitalization or post-hospitalization. We will not cover this disease, that disease. Don't go for it, right? You should compare some policies like that. But it's fairly standard. It's a very, very competitive industry. The health insurance industry is very competitive. So if Max offers something, Tata will also offer the same thing. Prudential will also offer the same thing, because they are all gunning for a business.
Sure, sir. So we have no more questions. We can go ahead with the presentation.
Okay, so this is again, I think there'll be a lot of debate on this, so I'll be happy to take questions. So these are some principles which are written by authors over ages. Like if you the famous book Rich Dad Poor Dad, there is one from there. There is the first one is fairly well known. Equities outperform. So the question, where do we park our money? How do you optimize it? Equities, well-known factors, they outperform other asset classes like gold, property, debt. Okay, so now a common question is, how do I allocate to equity? How much do I allocate to equity? So in my example, if let's say I have 100,000 rupees of disposable income, which is after meeting my entertainment and my household, then 100 minus your age. So if you are 20, 80% of that 100,000 rupees should go to equity, right? Now, the question in your mind may be why? Because at a young age, you can take much more risk, right? When you're 80, then the same amount becomes 20%. So 20,000 should go to equity and 80,000 should go to other forms like gold, debt, or whatever, right? So this is a risk, very back of the envelope way of deciding how much percentage or what percentage of your savings should be allocated to equity. Now, the third principle, which is extremely important, not a lot of people follow it, especially in India, is do not invest in a house, rent it. Because I'll give you an example. Let's say you want to buy a house for, you can check this in your vicinity, in your neighborhoods. Let's say you want to buy a house which costs about 1 crore. Just the interest component of that, even in today's environment, will be 6 lakhs per annum. Just the interest, minimum interest that you will pay on that is 6 lakhs on that 1 crore of loan. Whereas if you check the rentals of that, it'll be no more than 20,000 rupees a month. So that's 2,40,000 rupees. Now, what we do is we buy a house, we take a huge loan on it and keep paying EMIs of that. So the example I was giving to you of allocation of your disposable income, a large part of it goes in the house EMI and you are not able to save anything to create wealth. Okay. Then again, start early. Even small amounts matter. When I started working in 1997, I used to save even 3,000-4,000 rupees from my salary. That has grown with time, which is called the power of compounding, the last point on this page, because it multiplies over time. Just to give you a very back of the envelope calculation, a 15% compounded return over 5 years doubles your money. So 1 lakh becomes 2 lakhs in 5 years, and that 1 lakh becomes 4 lakhs in 10 years, and then that amount becomes 8 lakhs and then 16 lakhs, right? So in 20 years, your 1 lakh would have become 16 lakhs. So that's the power of compounding. And the 32, and then in 30 years it becomes almost 1 crore. So that's the power of compounding. You can just see that 1 to 2, 2 to 4, 4 to 8, 8 to 16 to 32 to 64. And, a small amount of 1 lakh can actually become 1 CR in 6 cycles. Okay, let me take the questions now.
So if you're comfortable, then we can go ahead with questions or with the presentation, as you say.
Yeah.
Like we are having questions, so if we could go with questions. Okay, so we are having one question regarding the gilt fund. Can gilt fund help us beat inflation? I mean, could you give us a little idea about the return of the gilt fund returns?
So gilt funds, this year the gilt funds are giving a return of about 6%, 6.5%, and the inflation is also just below 6%. So the reason to invest in a gilt fund is not to beat inflation. Yes, it is beating inflation this year. It had beaten inflation last year and maybe the last year as well. The idea of having a gilt fund is to have a safe avenue to park your funds, which at least covers inflation. Otherwise, you should never invest in a gilt fund.
So next question is from Adya Rajput. What are the different factors that saving depends on? Should one save only when there is a specific purpose of saving?
So this is what I was explaining earlier. What you should save is to create wealth. The objective to save should be to create wealth over a long period of time. And the way to allocate your money towards savings is spend the money on non-negotiables, allocate a substantial part of your disposable surplus to savings and the balance to entertainment, right? And the objectives have to be to create wealth. And that links in with the first principle I said here. Equity should be at a young age. Equity should be where most of your money should go to. So mutual funds which invest in equities, and if you don't have direct knowledge, stay with mutual funds. Otherwise, allocate your money even to stock market. If you are a financially qualified person who likes to study balance sheets and P&Ls and cash flows, then you may start investing directly in equities as well.
Also, there's another question. Where can we find such investments with 15% return interest rates?
So, if you look at if you go to some websites like Money Control, or if you go to, and there are a few more, but I mean, I personally like Money Control. They have um, mutual funds which are ranked as the top mutual funds. And if you study the returns they have given for the last 10 years, luckily we are in a country where the average return of a mutual fund, which is doing well, has been to the tune of 15 to 20% per annum for the last 10 years compounded. Okay. So, you just have to do a little bit of research on the web uh, through some of these websites, and you will be able to identify mutual funds which you can use to park your savings. And I'm a strong believer and a votary of investing in mutual funds in the large cap, middle cap, small cap categories, which are rated by various websites and companies. Even I think we keep seeing these ads on TV like mutual funds sahi hai, and I can share some of them with you, the organizing group. You can just go there, look at the mutual fund section, and they will give you the ranking of the top mutual funds. If you check the returns for any of them, that'll be around 15, 18, 20%. So I'm actually being very conservative when I say 15%. A lot of them are actually giving 18, 20% as well over the last 10 years.
Thank you so much, sir. If we don't have any more questions, you can proceed with the PPT.
So again, any question on any other principles? So this is what I wanted to cover. I'm open to Q&A now. Or any other topic anyone else wants to discuss from a budgeting perspective.
You could all enter that either in the chat box or in the Q&A window. So I think they're kind of thinking about it, maybe. I'm not sure. Yeah.
So tell me about the people who are attending, what does it look like? I have no idea. Is it what age groups? What is the demographic?
Right. So this actually, this boot camp is particularly for women above 18 years of age. And so we have women from all sections of the society with all kinds of educational backgrounds above 18 years of age. So we kept it absolutely open for everybody from all kinds of, all stratas of the society. So that's the demography. I mean, there's no real, we do not have like statistics saying that this is the section that we really have, but we have women above 18 years of age from all sections, whether it's educational or economic. So there's one
let me address that. I can see the questions now. So Simran has made a comment that I'm afraid to invest in the stock market. So no need to invest directly in the stock market, Simran. There are, like I said, there are portals which give you information on good mutual funds. You can simply go there, let the professionals do their job. They charge a very small amount of 0.5% per annum, and they give you fabulous returns of 15, 18, 20% per annum. So you don't need to take the risk. Now, the question of being afraid, let me give you a very, high level perspective of where the markets are headed. So you see, the BSE, or the Bombay Stock Exchange as it is called, was launched at 100 sometime in 1970. Okay. Today it is at 60,000. Okay. So how many times has it grown? 600 times? Right? So don't be afraid of investing your money. So if you had invested your money in, if let's say you had invested 100,000 rupees or 1 lakh rupees in the Bombay Stock Exchange, just in the exchange, okay, in 1970, that would have become 6 crores now, right? So you don't have to be scared because India is a growing economy, and the power of compounding, which is that the Indian economy, and I'll give you, and try to understand what I'll say now. You see, the stock market grows like this. If you understand how the GDP grows in India, the GDP grows um, about 7 to 8% per annum. Okay, that's the historical average. That's the gross domestic product, and I'm sure a lot of you could actually recall this from your college days. The gross domestic product of India typically has grown about 7 to 8% over the last 20 years. Now, this is the real GDP growth. When you add inflation to it, about 6% inflation that I was talking about, our GDP in nominal terms has grown by 7 plus 6, that is 13% per annum, right? And all the good companies in India, they actually beat the nominal GDP growth by about 4 to 5%. So a company like Infosys, a company like HDFC Bank grows by 4 to 5% more than the nominal GDP growth, or which I said was 13. So good companies actually grow from 18 to 20%. And those are the companies in which your mutual funds invest their money, and it keeps growing by 15 to 18% per annum, right? So you can't go wrong on that. Of course, there is a short-term fluctuation. Your prices can go down by 10%, but who cares? If your money can uh, grow 4 times in 10 years, then do you really care if you lose 10% in the short term? Because if you're scared of that, then you can't make money. Then you'll end up investing in FDs, and your money will become 4 times in 25 years or 30 years. Okay.
Yes, sir, there are multiple questions that have come up. It is said that investing in government stocks is safer. Is that true? Bhavika Chirani asks.
So, see, safety and return are opposites in making money, right? If you want to be absolutely safe, you will earn 6% and you invest in Government of India bonds, right? And if you want to take a little more risk, right? Even in, when I say risk, it means you're investing as an investor in HDFC Bank, as an investor in Infosys, right? Do you really perceive them as risky? Are these not banks and institutions which have already grown to become mammoth institutions in India and globally, right? So you have to, when you say risk, you have to think about it. Do you really think HDFC Bank is a risk? Don't you perceive that HDFC Bank will become a behemoth in the next 20, 30 years, as big as Citibank, right? So you've got to look at it like that and park your money with the right balance of risk and return, so that in the with the objective of being ultra safe, you don't end up actually losing money. Okay.
Right, sir. There's an anonymous question that has come up. As a young professional just entering the corporate world, what are some of the pointers in terms of budgeting that you would like to suggest?
I entered 1997 when I became a CA. Okay. I actually entered the corporate world. Someone may be asking the question exactly at that age. Look, I used to pay rent, okay, and I used to run my house. I used to pay even a car EMI, okay. I used to pay 4,000 rupees as a car EMI, my rent, my household. And if I was left with 4,000 rupees also, I used to invest that money in equities, right? And, you have no idea what equity returns can do to your wealth. You know what that 4,000 means. See, 4,000 is 40,000. Well, it's about 50,000 rupees over a year, right? And over 10 years, that becomes 5 lakhs. And 5 lakhs, imagine, compounded annually, can become an amount of wealth over a period of time, right? So no amount is small. Even if you're starting early as a professional, save a little bit, right? Go out, eat, dine, drink, but save a little. No amount is small.
Right. So another question says, how should I invest in mutual fund through app or through an LIC agent?
No, don't never go to an LIC agent. Invest. You are the new generation, most of you. Just download the app. Every mutual fund, whether it's HDFC or UTI or Kotak or whatever, right? All of them have apps. It's just the some dance of your fingers on the mobile, and you'll basically open your account, link it with your bank account. Correct, you will invest in it.
Okay, sir. So I'm having a question, and the same question is asked by Aasira Verma. So she wants to know, even I want to know, how to start the investment journey through Grow app. Like, it's safe or something, and what are the suggestions from your end?
Grow is that share market app, right?
Yes, sir.
So Grow, Zerodha, ICICI Direct, HDFC, these are all intermediaries for between an individual and the stock market. Okay. When it comes to using Grow or Zerodha or HDFC Securities or ICICI Direct, these are just apps. When you invest in stock market, either you go by advice of a wealth management firm, financial advisor, where do you want to invest, right? Or use your own analysis. Do not just invest if someone says, hey, invest in XYZ company, it will double. It will not double. It may actually go down by 90%, right? Never believe in tips. Either do your own research, okay, or um, take the help of a financial advisor. Okay, otherwise Grow is just an app. It's you these days they let you invest by swiping right or left, like Tinder. And in old days you just used to say submit or whatever, right? Buy or sell, and only the interface has changed.
We have one question from Khushbu. Can you please suggest some specific principle methodology at random to be considered while creating wealth?
Yeah, sorry, repeat that.
Can you please suggest some specific principles methodology at random to be considered while creating wealth?
So, like I said, prioritize your allocation of savings to equity. How much is 100 minus your age? So if you want to save 50,000 rupees a month, okay? If you want to save 50,000 rupees a month, and if you are 25 years old, then 75% of that, which is 100 minus your age, 75% of that 50,000 should go to equities. So two broad principles. In which mutual fund, I can name a few mutual funds for people who are interested. But I think that's a list. You can go to Canara, Rebecca, Blue Chip Fund. You can go to a lot of funds are there. You just go opens up money control apps. If you can see my screen here, I'll just point this out towards you. This is a money control app. Okay, if you can see the screen. Okay, now I'll just go to one of the tabs which says mutual funds. See this, if you can read it. I don't know if you can read it. In the app, it says mutual funds. Okay, I don't know if you can read it.
Yes, so we can very, very vaguely read it.
Okay. So if you go to mutual funds, it will give you the top mutual funds in various categories, large cap funds, and you can rely on this. This is based on research. So my recommendation to the one who asked the names of mutual funds is download the app mutualmoneycontrol.com. There are plenty, right? But this is my personal favorite, moneycontrol.com. Money Control is run by a company called TV18, which is owned by Ambani's, Mukesh Ambani. So all of you now can understand what I'm talking about. And go to the mutual fund section, go to the top funds, select the top funds. Those are the funds you want to invest.
All right, so the next question is a little personal. I don't know if you would wish to answer this, and it is obviously anonymous. It says some stocks where you have personally invested in.
Oh, stock tips, huh? So, yeah, I do invest. I started in 30 years back. So I can give you one recommendation today for those who want to invest. You can buy in Bank of Baroda. I think it'll give a 25-30% return easily this year, if not more. Anyway, that's the purpose is not to give you stock tips. There are plenty, you can, you just have to do a little bit of research.
Sure, so we seem to have no more questions. In case there's anything else that you would want to add, and the other attendees could drop in their questions while sir is actually presenting.
No, I think I've covered everything. What I would suggest is, again, go back to the principle, start saving early. Don't shy away from equities. Some predictions of where the Indian economy is heading and the stock market is heading is, some reputed institutions have said, and forget the stock markets. In equities, you can almost double your money in every 5 years.
So there's another question that has come up from Lakshay Gupta. He's saying, what is your take on NFTs and cryptocurrency as an investment option?
So look, I'll give you a few broad. I don't have a personal view. I don't want to share my personal view, so that it's a topic which is being discussed by central banks across the world, by economists across the world. So it's a topic which is not yet fully discussed and discovered, right? There are companies like Tesla which are open to taking payments in the form of cryptocurrencies, and there are people who say it will become zero, right? And Tesla is a big company, and so are central bankers, which say that our own central banker says that we should ban cryptos. The governor of RBI, Shaktikant Das, he says we should ban cryptos, right? So, I don't want to share my own view, but yes, cryptos are extremely risky investments. First of all, they are not currencies. That's a clear thing you should take in mind, right? It is not a currency, it's a speculative asset, right? It is based on technologies like blockchain, which make them useful in certain cases. And blockchain is basically a shared ledger, right? So it is useful for certain use cases, but should you invest in this asset? I'm not going to give you a view. I have not invested. I'm not going to invest in cryptocurrencies. My money has been earned with a lot of hard work, and I believe that I should not waste my money by being in an asset which can drop from 60,000 to 30,000 without any logic, go up from 1,000 to 60,000 without any logic. So it's too speculative for me.
Right, so this is definitely somebody like me who's asking this question. It's an anonymous question, and he or she says, what are equities in simple terms?
Equity in a simple term is, okay, so this is back to the very basic stuff. When you want to start a business, you can either use your own money, right? Or you can borrow. Equity is the own money part. So let's say I want to open a cafe, right? And let's say to open a cafe, you need 10 lakh rupees. That 10 lakh rupees can be your own money, or it can be the money from a bank. When it is your own money, it is equity, right? So when Mukesh Ambani started, or rather not Mukesh Ambani, Dhirubhai Ambani started Reliance, right? He would have started Reliance with, let's say, and today Reliance is like a behemoth. It's like 15, 20, I don't know, $100 billion company or $200 billion company. But he would have started with 5, 10 lakh rupees from his own pocket. That became his own equity. Then he would have gone to the bank and said, okay, give me 10 lakh rupees more. I'll put up one more plant somewhere, right? One more factory somewhere, right? So the bank would have gone through his financials, that is it safe to give him money? And they would have said, yes, this guy sounds good, right? So equity is the risk capital which either the entrepreneur invests himself, right? Or borrows from the, not borrows, actually borrows is the wrong word, or collects money from the stock market. That's equity. Versus debt, which has a fixed rate of interest or a cost, which is to be given back to the lender like a bank. So if the business doesn't do well, equity becomes zero. You've still got to sell your assets and pay to the bank.
Right. So, all right, sure. There's one question from Kanika Agarwal. She wants to know, I want to start investing in stocks. I know analysis, but I'm a fresher. So is it weird to start with 2 to 3 stocks that sums up to 500 rupees?
Yeah, so anything is good. Thankfully, in today's time, you can buy one share for 10 rupees as well. In our times when we started, there were no concept of one stocks. If the stock was 100 rupees, you had to invest 100 rupees. Today, you can even, 100 into 100 minimum, right? So you have to invest 10,000. But today, you can invest one share in 100 rupees. So it doesn't matter. If you know analysis, yes, my recommendation is stick to at least why even 2, 3. Start with one stock. Okay, do your research properly. I'm also writing a book. I'll give you some principles from that. It's called Five Senses. I think some of you can take back something from it. Look, in fact, I should have included some of that. I didn't realize there would be questions on investment, but let me just tell you that all the wealth that is getting created around us in the world, you can actually sense how it is getting created. Now, what are the five senses? Your five senses are your eyes. So what do you see? Your ears, what do you hear? Your smell and all that stuff, right? What do you eat? Your taste. Now, let me give you one example. When we go out, right, to satisfy our senses, we eat, drink, watch movies most of the time. Is there anything else we do, right? We go to pubs, we go to dinners, we go to watch movies. Now, do you know that when we drink, invariably we are spending money on product of a company which is into that business, right? And in India, there are a couple of companies, United Spirits, United Breweries, which belong to Vijay Mallya at some point of time. The amount of wealth that we have enabled these entrepreneurs to create, right? Unfortunately, we didn't make money when it would have been great if while drinking, we also bought one share of Kingfisher or United Spirits, right? Then the cost of our dinner would come out of the money we will make out of that stock, right? So five senses means when we eat something or drink something, we are spending money on a product through which someone is making money, and that someone is a company, right? When we go to a hospital and we spend a lot of money on the treatment of our near and dear ones. Some Apollo hospital, some Fortis Healthcare, some Max Hospital is making money, right? So you have to make money by just observing things around you, right? When everyone is chatting on Facebook, on WhatsApp, and everyone has an account on Facebook. Facebook has grown from a 100 million company to a $3 trillion company or whatever, more than a $1 trillion company, right? So you've got to make money. When the reason I'm giving these examples is that wealth is all around us, right? When carpenters come and do our woodwork, right? Which adhesive do they use? They use Fevicol. Fevicol is made by a company called, have you ever seen any other adhesive? No. Sometimes they get a but it's 90% Fevicol. Fevicol is made by a company called Pidilite. Pidilite has given a 40% compounded return. We were talking about 15% here, right? Pidilite has given a 40% CAGR over the last 20 years. The carpenter who was doing the woodwork at our home was using a product where the company was making 40% compounded returns every year, right? So keep your eyes and ears open. Whatever you consume, smell, eat, drink, right? All of that is a source of making money. After that, you do the analysis, right? After that, you study. That I'm not suggesting, go out and buy blindly. We all use Paytm, but Paytm is not the right price. The investors have already made money in that when it listed, but that's how you make money. See, all the big investments today are Swiggy, Zomato, Paytm. Of course, they're very expensive now, but keep an eye on what you are consuming, seeing, drinking, eating, etc. Five senses. So that's my next book, actually.
Sure, sir. Another question related to cryptocurrency here. Also, what do you think of 30% tax on crypto, which will make it difficult to invest in it?
You see, taxes, whenever you put a tax on something, it feels bad. Okay. But we have been paying tax. Everyone has been paying tax on all of the forms of income. So I don't see it as a disincentive for investing in cryptocurrencies. If cryptocurrencies are good, you should still go ahead and and make your own judgment. If they are good, I have given my view. If they are still good, look, 30% tax you will pay only when you make money. No, if you don't make money, where is the tax? Right? So if you make a profit of 100, pay tax of 30. So still earning 70. Now look at 70, not 30.
Right. So the last question here is, my parents do savings in post office schemes. Is it really worthy? And best alternative of post office savings?
See, my parents also did in post account savings, right? So generation has changed, right? I don't believe post office should be even visited for anything. So these are old saving instruments, nothing different from gilts.
All right, so sure. There are no more questions that we'll be able to take because we're falling short of time. But we have one question. This question is, what is blockchain?
Okay, so I'm not an expert on blockchain, but blockchain is basically a distributed ledger. Okay, so in which if someone is an accountant will understand. So if there are let me try and make it easy for everyone to understand this. So blockchain is a distributed ledger where all the sides of the transaction auto match. Okay. Now, what is a ledger? When there is let's say two people, Anchal and Yashika, are dealing with each other, they keep giving and taking money from each other throughout the year, right? In the year, they make 100,000 transactions, right? Now, what happens is if you keep a account of this in Excel between Anchal and Yashika, you will need to invariably balance it out at the end of the year. Anchal will say, no, I gave you 50 times. Yashika will say, no, you gave me 49 times, right? So you start balancing it. You'll reconcile it, right? A distributed ledger will always be balanced because every transaction has a, auto whatever reconciliation. So all the parties in the distributed ledger, they agree to the transaction and there is never a mismatch. You can't change the rules of that. And that's why it's called a distributed ledger. So blockchain is basically a distributed ledger.
Thank you so much, sir. We don't have any more questions. I wanted to ask one last question from my side. Like, being a young investor, I would just like to ask that, is it we should invest for long term, or we should just do the buying and selling thing when we are investing on stocks?
You see, no one makes money in buying selling. Yeah? There are, if you do buy sell trading, you have to be a pro. You have to do your education and technicals to do that. My personal view is don't fritter away your hard-earned money in trading. You earn for 10 days, on 11th day you lose everything. What you have earned for 10 days, invest long term.
Thank you so much, sir. I guess we have come to an end of this question of this session. Sorry. I think each one of us here has enjoyed this session and it was deeply enriching. So we have learned from you a lot, sir, be it from the basics of finance and be it from starting investing early to equity. We would like the students, the attendees, to fill the link feedback form, which will be provided in the chat box. I'm really sorry for that. And the next session tomorrow is scheduled to begin at 7 p.m. It is based on tax planning and insurance with our esteemed speaker, Ms. Kanishka Kakkar. thank you so much, sir, for your presence. It was very nice being with you here, and you have, definitely cleared the doubts of most of us today. Thank you so much, sir.
All right. Thank you. I hope you
Thanks a
all
lot,
take
sir.
away something
Thank
from
you
this.
so much.
Yeah.
Surely we did. Thank you so much. Have a great evening. Thank you, all the attendees. You can exit the meeting. Have a great evening. See you tomorrow.
Back form. So we are really soon.
Those of you who want to fill the feedback form for giving us suggestions, we'll be sending the link shortly. Since most of the participants have already left the meeting, we'll be sending the link on the group itself, so you all can leave now.